This price move should not be possible. In late January 2026, silver didn't just climb, it escaped containment. In a single trading session, it surged more than 12%, a move worth roughly $12.50, blasting past $116 an ounce. Gold crossed 5,100 at the same time. Here's the contradiction. Markets built for slow, controlled pricing are now producing vertical moves, while the systems meant to regulate them are barely reacting. This matters to you because when assets reprice in days instead of years, money stops behaving like a stable reference point. Silver wasn't long ago sitting near $33. Now it's more than triple that, with a market value around $6.3 trillion. Moves that once took months are happening inside 24 hours. But here's the part nobody is saying out loud. This doesn't look like enthusiasm, it looks like urgency. Traders aren't chasing returns, they're chasing exit doors. When markets stop respecting ceilings this fast, one question becomes unavoidable. What force is strong enough to push them through anyway? What we're watching isn't a random spike. It's part of a pattern that's been quietly forming, then suddenly snapping into view. The core event is simple on the surface. Silver and gold are repricing violently upward at the same time. Silver is trading above $112 in Western markets. In parts of Asia, it's been bid far higher. Gold is holding above 5,000. But notice what's missing from that description. There's no single announcement, no official policy change, no headline event big enough to justify moves of this speed. That's the signal. When prices detach this fast without a clear trigger, it usually means the real pressure isn't visible yet. The market is reacting to something structural, not emotional. Historically, metals don't move like this unless there's stress elsewhere, forcing capital to relocate quickly. And this isn't happening in isolation. It's coinciding with rising volatility across currencies, bonds, and commodities at the same time. So here's the reframing question that changes how this looks. What if these prices aren't rising because metals are strong, but because something underneath them is weakening? Once you see it that way, the rest of the move starts to look very different. Here's the claim that makes sense of the chaos. This move isn't being led by Western markets anymore. It's being pulled from the outside. Look at where the highest bids are coming from. While silver trades near $112 in US markets, buyers elsewhere have been willing to pay dramatically more. In some sessions, prices in Asia push toward $130 an ounce. That gap isn't noise, it's arbitrage. And arbitrage only exists when physical demand overwhelms paper pricing. Here's why that matters. Futures markets can quote any number they want, but when someone is willing to pay $15 more per ounce to secure metal now, that tells you availability matters more than price. This isn't speculation. This is acquisition. Notice what they didn't deny. They didn't say supply was plentiful. They didn't say delivery was easy. Instead, trading limits were tightened. Position rules were changed. Controls were introduced to slow the move. That response is revealing. When authorities try to cool a market instead of reassuring it, it usually means the pressure isn't coming from traders. It's coming from necessity. And once physical demand starts dragging price upward across borders, paper markets don't lead anymore. They follow. That's when pricing power quietly changes hands. Now watch how fast this escalates. Once pricing power shifts away from paper markets, volatility stops being an accident. It becomes the default. What would normally be considered an extreme daily move starts showing up repeatedly, and instead of triggering caution, it becomes normalized. A $10 swing in silver used to be unthinkable. Now it's something traders wake up expecting. This has happened before, but never quietly. In past commodity stress events, authorities stepped in early, loudly, and forcefully. They reassured markets, they expanded supply, they restored confidence. This time, the response is different. Controls are reactive, limits are defensive, and none of it is slowing the bid. That's the red flag. When markets accept disorder as normal behavior, it means the underlying imbalance is growing faster than the tools meant to contain it. What should be shocking becomes routine. What should be temporary starts to feel permanent. Here's why that detail changes everything. Once participants believe there is no upper reference point, behavior flips, selling dries up, coverage turns urgent, and every attempt to stabilize price just confirms that stability is gone. At that point, momentum isn't driving the market anymore. Fear of being late is, and that fear is about to find its next pressure point. Here's where the story stops being abstract and starts breaking institutions. As prices ripped higher, some of the biggest players on the sell side quietly stepped back. Retail silver products were suddenly unavailable from major banks. Sales were paused. Inventory vanished. That's not a technical glitch, that's stress, especially when those same institutions had been active sellers as prices were far lower. Now notice the contradiction. Publicly, markets are said to be functioning. Privately, access is being restricted. If supply were healthy, selling would continue into strength. Instead, it stopped. And at the same time, senior figures inside major trading desks began exiting their roles right in the middle of the rally. That timing matters. When short positions move violently against their holders, there are only two options: buy back at higher prices or step aside and absorb the damage. In a small market like silver, even modest short covering creates explosive feedback loops. Every forced buy pushes price higher, triggering the next one. Here's the line that permanently changes how you see this. When the biggest sellers can no longer sell, the market loses its brakes. From that moment on, price doesn't need new buyers to go higher. It just needs existing ones to panic. And that panic is spreading faster than most people realize. Now stack the pressure points. At the same time, metals are surging. A long-standing source of global liquidity is breaking down. For decades, cheap funding flowed from one place, quietly supporting risk everywhere else. That flow is now reversing, fast. Borrowing costs that sat near zero are jumping. Yields that were once pinned are moving freely. And when funding stops being cheap, leveraged positions don't unwind politely. They unwind all at once. That forces liquidation. Assets get sold not because they're bad, but because cash is suddenly needed somewhere else. And here's the twist. The money coming out isn't going into safety, it's avoiding currencies altogether. Now watch how quickly this compounds. Rising yields create volatility. Volatility forces deleveraging. Deleveraging pushes capital toward assets that don't depend on confidence in repayment. Each step feeds the next. This is why moves across metals, bonds, and currencies are happening simultaneously. It's not coordination, it's reaction. What happens if this continues? Because once a funding engine shuts down, restarting it isn't a policy decision. It's a credibility problem. And credibility, once questioned, is hard to restore. Now bring this down to where you live. If prices are moving like this, the impact doesn't stay on trading screens. It shows up in access. It shows up in timing. It shows up the moment you try to do something simple, like buy or sell at the quoted price, and realize that price is theoretical. When volatility explodes, availability becomes the real constraint. You're told an asset is worth one number, but when you try to act, the spread is wider, the wait is longer, or the transaction doesn't happen at all. That gap is where confidence breaks, not because people don't want the asset, but because the system connecting buyers and sellers starts to fail under speed. This is how ordinary behavior changes. People stop waiting for pullbacks, they stop trusting delays, they start prioritizing possession over price. And once that mindset spreads, markets accelerate without needing headlines to push them. If this feels familiar, say so in the comments. Because when enough people independently reach the same conclusion, it stops being sentiment. It becomes momentum. And momentum like this doesn't slow gently. It either exhausts itself or it forces a deeper reset. To understand why this keeps happening, you have to look past the emotion and into the mechanism. Modern markets run on leverage, timing, and confidence that someone else will always make the next trade. When that confidence holds, prices behave. When it cracks, systems amplify stress instead of absorbing it. Futures markets multiply exposure. Credit lines assume smooth turnover. Supply chains assume time. None of those assumptions survive vertical moves. Here's the unsettling insight. The system isn't designed to handle speed without trust. The faster prices move, the more every participant depends on everyone else staying solvent, liquid, and calm at the same time. That's not resilience, that's fragility disguised as efficiency. Now notice the incentive problem. Authorities try to slow prices, not because they're wrong, but because rapid repricing exposes leverage they can't see or control. Institutions pull back not to signal danger, but to avoid being the last ones holding risk. This is why volatility becomes self-sustaining. Every protective action confirms that protection is necessary. Once that realization spreads, markets don't wait for permission to move. They move first, and explanations come later. And that's when the future stops being a forecast and starts being a countdown. From here, the path splits, but neither direction looks calm. One possibility is stabilization through force. Controls tighten, trading limits expand. Liquidity is injected wherever stress appears. Prices pause, not because the imbalance is solved, but because time is bought. In that scenario, volatility compresses temporarily and confidence is patched just long enough to keep the system functioning. The other path is momentum overtaking management. Physical demand keeps pulling supply forward. Sellers stay scarce. Every attempt to cap price confirms that caps are necessary. In that world, repricing doesn't reverse. It stair-steps higher, punctuated by violent pauses, as markets search for a level that feels real again. What matters is that both paths share one feature. Uncertainty accelerates. Decisions are made faster. Risk tolerance shrinks. And participants stop assuming tomorrow will look like yesterday. Here's the part that should hold your attention. You don't need consensus for this to continue. You only need enough people to act early rather than wait. And right now, the next move isn't theoretical. It's already forming under the surface. Here's the insight that ties all of this together. This isn't a story about metals getting expensive. It's a story about reference points breaking. When prices move this fast, they stop being signals and start being symptoms. Silver didn't suddenly become more useful. The system around it became less trusted. Once that happens, markets don't ask what something is worth. They ask what still holds value when timing, leverage, and promises fail at the same time. That's why ceilings disappear. That's why volatility feels permanent. And that's why calm explanations arrive too late. What you're watching now is a repricing of certainty itself. And this layer isn't finished. The next phase doesn't start with prices. It starts with responses. If you want to stay ahead of that shift, follow and subscribe. We're going to keep breaking this down as it evolves.